We begin in Turkey, where the country's central bank is predicting a slower pace to rising prices in 2023. It's now forecast an inflation rate of 22% for the year.
Turkey's central bank has raised interest rates from 8.5% to 15%. That's almost double. It's the first rate hike since December 2020.
As you may know, Turkey has been grappling with an enduring economic crisis for an extended period of time due to President Erdogan's unconventional approach to monetary policy. This unusual approach, which we'll take a look at in this video, has caused the Turkish Lira, the nation's currency, to experience a consistent depreciation and increasing inflation, set to lead Turkey towards a financial crisis. Now, it's important to note that after President Erdogan's victory in the presidential election held in May, analysts and economists previously believed this was going to mean a glimmer of hope for Turkey's economy. After all, right after the elections, he appointed new leaders for the finance ministry and central bank, who promptly executed interest rate hikes. However, their strategy didn't yield the desired results, and the lira plummeted to an all-time low of 27 against the US dollar, while inflation surged from 38% in June to 48% in the month of July. These issues, the reasons behind Turkey's economic troubles, why interest rate increases have failed to stabilize the situation, and how these issues impact Erdogan's prospects in the upcoming municipal elections are the points we'll explore in this video. Now, let's get into the background. The decline of the lira actually started around 2018, but the situation became a lot worse after the outbreak of the pandemic, which led to increased inflation worldwide. Normally, central banks would raise interest rates to combat inflation in such an instance, but at the time, President Erdogan preferred lowering rates in Turkey instead. From his perspective, he argued that his decision was because higher interest rates were part of a conspiracy propagated by what he referred to as the interest rate lobby, a supposed cabal of Jewish financiers committed to destroying Turkey's economy in order to control the country. We don't buy it, though. We believe he actually chose to lower rates because he was aware, as many Western countries have discovered, that raising interest rates can inflict substantial economic pain, even if it eventually does help reduce inflation. So, in his pursuit of this policy, Erdogan dismissed any central banker who dared oppose him, causing the central bank to lower rates from 19% in late 2021 to a new low of 8.5% in March 2023. And of course, as anticipated by conventional economists, these low interest rates further devalued the lira, which in turn increased inflation. Now, to put it in perspective, the lira actually fell from 8 to the dollar in 2021 to nearly 20 lira to the dollar at the start of March 2023. Turkey's official year-on-year inflation rate also peaked at 85.5% in October 2022, with unofficial estimates suggesting it was around that figure. Given these terrible developments, Erdogan found himself in a precarious position in the lead up to the May election. The lira was rapidly depreciating, pushing inflation to politically untenable levels and eroding the purchasing power of ordinary Turks. Yet Erdogan knew that the conventional solution, raising interest rates, would be politically embarrassing and could risk pushing Turkey into a recession. So instead, he maintained low rates at 8.5%, but also used Turkey's foreign exchange reserves to keep the lira at around 20 per dollar. Basically, he instructed the Turkish central bank to spend billions of dollars and euros purchasing the lira on international markets, artificially propping up its value. This practice is known as currency defense, and while it can be effective temporarily, it's often financially burdensome and ultimately unsustainable. Proof? Well, in the weeks leading up to the election, Turkey's central bank reportedly spent nearly $9.5 billion worth of its foreign reserves on said currency defense, and its net reserves, after subtracting its obligation to other Turkish banks, plunged into negative territory after the election. Now, once the election ended, Erdogan stopped defending the lira, which caused it to swiftly depreciate to approximately 23 to the dollar. After finally recognizing the need to change his interest rate policy, Erdogan then appointed Mehmet Şimşek as finance minister and Hafizge Erkan as central bank governor in early June. Just a few weeks after his election win, both Şimşek and Erdogan were seen as individuals with a sound economic track record. They had spent a substantial part of their careers at prominent Western banks, and they had even publicly expressed their disagreement with Erdogan's unconventional monetary policies. As expected, they initiated interest rate hikes shortly after assuming their positions, implementing a 6.5% increase in late June, bringing rates to 15%. Now, these increases at first seemed high by Western standards, but it's crucial to remember that this is a country grappling with persistent double-digit inflation and a currency that has lost 80% of its value since the onset of the pandemic. What better choice did they have? In a surprising twist of fate, though, this measure taken by Şimşek and Güran also didn't work out well for Erdogan and the economy. The lira still continued its decline, reaching 26 against the dollar in July and plummeting to 27 in August, while inflation, which had previously been on a downward trend, surged from 38% in June to 48% in July. Turkey's trade imbalance was also notably adverse, indicating an excess of imports over exports, which boded poorly for the lira, because typically a trade deficit has negative effects on a nation's currency. Now, in response to this disheartening economic data, the Central Bank of Turkey took an unexpected step by raising interest rates by a staggering 7.5% a couple of weeks ago, pushing the country's headline interest rate to 25%. Much to our surprise, the lira was not greatly affected by this development, but things still took such a dire turn that the Turkish central bank found itself compelled to restart its defense of the lira, spending billions worth of foreign reserves in the process. The story so far now begs the question, why are the interest rate hikes proving so ineffective in Turkey? Well, we can think of two principal reasons. Firstly, the sluggish pace at which the interest rates get increased is a pressing concern. Turkey's real interest rates are in a sense stubbornly and significantly negative compared to its inflation rates, which seem to continue to increase far above the threshold met by the interest rates. For instance, following the elevation of the interest rate to 25%, the inflation rate in Turkey stood at 58.9% in August 2023, showing a very fast growth in the relentless tide of rising prices that Turkish citizens recognise even a 25% interest rate won't save them from. And when faced with this economic reality, many opt to spend rather than save, which is a behaviour that only serves to perpetuate the cycle of inflation. Secondly, investors don't really have much confidence anymore in President Erdogan's commitment to implementing the necessary interest rate hikes, because Erdogan has made his ideology on interest rate increases unequivocally clear. But with municipal elections looming on the horizon in approximately 6 months, who knows what he'll pull off? For the coming elections, for instance, Erdogan's political strategy leans towards spending funds to secure voter support, a strategy that's pretty similar to the tactics he employed prior to the presidential election, where he increased the minimum wage and granted pay raises to public servants. However, for whatever strategy he props up to give himself victory, it still won't change the fact that his reluctance to approve increases to the country's interest rates places him and his ministers in a precarious and delicate situation. In conclusion, the Turkish government's dilemma looks like this. They must make a difficult choice between two different courses of action. On one hand, they can opt for the swift and substantial elevation of interest rates, which would be a move laden with risk, because such a bold approach carries the potential for a recession, and it could also harm Erdogan's electoral prospects in the 2024 elections. Nonetheless, it also offers the possibility of curbing the rampant inflation and attracting international investors, which could, in the long run, stabilise Turkey's economic outlook. On the other hand, they could choose a more cautious path, which includes gradual rate adjustments designed to maintain voter satisfaction leading up to the municipal elections. However, this approach carries its own set of consequences, potentially increasing Turkey's inflation woes and sending a disquieting signal to the global economy that the nation is dealing with profound and enduring economic challenges. The weight of these decisions looms heavily over Turkey's economic landscape, making the path forward all the more uncertain. Alright, that's all for today's video. If you enjoyed it, please leave a like and subscribe to the channel. Also, please share this video and press that post notification bell so you don't miss out on our future videos. We analyse the latest trending economic news, so watch out. And until next time, take care.